students, and welcome to Principles of Financial Accounting. Today we're going to talk about the accounting equation, which is assets equal liabilities plus owner's equity. The accounting equation is the basis for all parts of the accounting system and what we need to learn first in order to understand how accounting works. Let's look at the elements of the accounting equation. First, assets. Assets are economic resources that can be used in a business and very simply are things of value. Liabilities. These are debts, things that we owe to other people, to creditors, to banks, or to other people. Owner's equity is the amount that we have in the asset ourselves. Assets always have claims against them. In other words, who owns the asset? Who has the right to sell it? Okay? If we have credit, if we borrowed money against an asset, then the creditor has the first claim. So the debt has the first claim, or the creditor has the first claim against the asset. Then the owner has the remaining claim. So, if you bought a car and you financed it and you didn't make your payments, what would happen? Well, certainly the bank would come and repossess your car because they have the first claim against the asset. And then they'll pay off the loan, and anything left, you might get a little bit out of it, but more than likely not much. Okay? Let's look at this accounting equation from a personal standpoint, talking about the automobile. Let's say that you purchased an automobile for $25,000. And you put down on that automobile $5,000. Keeping the numbers round so it's easy to come up with numbers. If you put down $5,000 and you bought an asset for $25,000, obviously you had to finance $20,000. So putting that into the accounting equation, even from a personal standpoint, you've got $25,000 in an asset, you've got a $20,000 debt, and you have equity in the car of $5,000. Okay? You also may purchase a home. Let's say we purchased a $200,000 home and we financed or took a mortgage out for the home of $180,000, putting $20,000 down ourselves. That's about 10%, isn't it? Okay? So what we have here is an asset of $200,000, a liability that we owe to the bank or the mortgage company of $180,000, and $20,000 in equity. Now, as we make payments against these loans, this amount goes down, this amount goes up. But the accounting equation would always be in balance. Okay? Let me erase this a little bit, and I'm going to talk about the owner's equity before we get into transactions. Okay. Owner's equity can be increased in a business in a couple of ways. It can be increased by the owner putting money in, so we'll call that investments. And we're going to put that into our main owner's equity account, which is called capital. Owner's equity can be increased by revenue, so we'll set up some revenue accounts. It can be decreased with expenses. We know we have to have expenses in order to generate revenue. So we'll set up some expense accounts, and then we also can take money out through withdrawals. If a sole proprietor is operating a business, they don't have any other income from anywhere else, or usually they don't, so they have to take money out of the business on a regular basis. And usually the sole proprietor will take out a set amount, maybe by the month or over a regular period of time. Okay, what we're going to do next is talk about how transactions affect the accounting equation, but that's going to be in the next video.